Welcome to ForexTV.com's PM Exchange. It's Wednesday, February 27th. I'm Remy Hoki. Today I'm joined by David Powell, currency strategist at IDEAglobal. Good afternoon, David.
Good afternoon, Remy.
Great to have you on the show today.
It's a pleasure to be here.
Well, it's been quite a volatile session in the FX markets. We saw euro-dollar hit another high, breaking above 150 and hitting a high at 151.43. But we had a lot going on in the morning session, as well as Bernanke's comments. So at this point, where do you see euro-dollar headed?
Well, you're right. We did have a combination of events that were very negative for the dollar today and resulted in euro-dollar making a new record high. There was a report for durable goods orders which came in below expectations, which suggests that manufacturing activity in the U.S. is going to be weak once again in the first quarter of 2008. There was a new home sales report that came out that was below expectations and showed that month's supply of homes for sale has increased and that prices have dropped more than 15% year over year now, which was a huge jump from what we saw last month. And essentially, these negative events proved that there is further deterioration in the U.S. economic outlook, and Bernanke confirmed in his semi-annual testimony to lawmakers today that the Fed would indeed cut again at its next meeting by stating that the Fed remains more concerned at this stage with growth and there are further risks to the downside. Essentially, we're looking for a 50 basis point cut, and that has certainly been a negative factor for the dollar. And we did break an important level of resistance on euro-dollar today, which came in at 151.30, which was a 3-month channel top, and as you mentioned, made it towards 151.50. However, euro-dollar then retreated, and we would really need a break above 151.50, a close above that level, in fact, to suggest further gains. And then we would be targeting a move to 154, 155. But until we see that sustained break above 150, 150, we do remain vulnerable to a retracement.
Well, David, we've seen dollar weakness across the board, and today the U.S. dollar index fell to its lowest since its inception in 1973. And another currency that's been gaining strength against the U.S. currency is sterling. Meanwhile, we saw euro sterling hit another record high in today's session. So for the UK currency, if you could outline the fundamentals that will drive the currency and where you see sterling dollar going.
Right. The outlook for sterling is certainly not as bright as the outlook for the euro. In fact, the dollar sell-off is much more pronounced today versus the euro than sterling. Towards the end of the session, cable started to fail. In fact, in the short term, our technical desk looks for cable to fall down towards support that comes in at 197.90, which is the January 17th high, and then to 197.35, which is the February 14th high. And on the crosses, the outlook does not look particularly favorable for sterling, given the economic problems that the UK economy faces, which are very similar to the problems that the US economy is facing. Essentially, a credit crunch. The credit crunch has caused credit to dry up, and the consumer is facing a number of headwinds there, and the BOE is poised to continue cutting rates as the year goes on. And we think that attractive play at this moment is to be short sterling Swiss, looking for further moves to the downside as the outlook for sterling continues to deteriorate.
Well, indeed, in today's session, we saw real money demand for euro and selling for sterling. But speaking of high yielders, we've also seen the so-called dollar block currencies of Aussie and Kiwi gain against the U.S. currency. So starting out first with Aussie dollar, which has rallied past the 94 mark, where do you see Aussie going forward against the U.S. currency as well as the yen?
Right. At this stage, the outlook does remain favorable for the Australian dollar. In fact, all the commodity currencies in the G10 space have rallied, including those of New Zealand and Canada as well. It was a significant level that we broke above in Aussie dollar today, the November high of 94, which previously had been a level of resistance. On a multi-week basis, we look for Aussie dollar to rally to 98.15 level of resistance that is formed by a Fibonacci retracement level. And the outlook for a stronger Australian dollar is supported by the tightening bias of the RBA, which is again expected to raise interest rates by 25 basis points in the first half of this year after having just done so recently. The outlook for Aussie yen is less clear because of the fact that the yen does potentially face appreciation as these high levels of volatility we see leave the yen carry trade unpopular. So we do believe that Aussie dollar is a clearer play at this moment and would suggest expressing a view of Aussie strength versus the dollar as opposed to versus the yen.
Well, David, you just gave us your take on Aussie dollar, but what about the U.S. currency against the yen and the euro-yen cross?
Right. At the moment, the euro-yen cross has rallied as the euro is essentially rallied across the board. The euro-dollar's rallies not only due to dollar weakness, but also to independent euro strength, helped by comments from members of the ECB, in particular Weber, who has underlined that expectations for a cut in the eurozone are misplaced, essentially, with the with the ECB worried about second round effects in terms of wage inflation. The outlook does look favorable for the euro. And in terms of not only versus the dollar, but in the crosses too, but in terms of dollar-yen specifically, we haven't seen a decisive breakout of its recent range and really remain within this 105, 108 broad range, and would really need a move on one side of that range to conclude that a sharp movement in either direction is imminent.
Okay, David, last but not least, before we wrap it up for today's interview, if we could look ahead to Thursday and Friday's session. It's been quite a week with all the U.S. data releases, but we do have significant data coming out, including Q4 GDP in the U.S., as well as personal income spending and Chicago PMI. And recently, given the inflation data we've been getting from the U.S. in conjunction with commodity prices rallying, the term stagflation has been thrown around. But at this point in time, what is your assessment of the U.S. economy?
Right. Well, the outlook for the U.S. economy has deteriorated significantly. As you mentioned, on Thursday, we'll see the Q4 U.S. GDP. In fact, it's the preliminary reading, which is coming after a not very strong advanced reading, which only came in at 0.6%. There certainly is a possibility that that could be revised away completely to show negative growth in the fourth quarter. And also, as you mentioned on Friday, we do have personal spending income reports, which will likely underline the headwinds that the U.S. consumer is facing. So the economic outlook for the U.S. does remain not so bright at this stage. However, the fiscal and monetary stimulus being thrown at the U.S. economy right now would support the notion that the U.S. economy will recover toward year end, which will spark a dollar rally at that stage. In terms of stagflation, we are in a period of subdued growth and higher levels of inflation. However, that term stagflation was used in the 70s when inflation was much higher than it is now, around 10%, and unemployment was much higher than it is now, around 10%. That compares to current levels, about 5%. So it does seem a bit misplaced to use that term describing current economic conditions, and we are a long, long way from the conditions that were in place in the early 70s when that word was used more commonly. So I certainly would avoid referring to the present situation as a period of stagflation.
Okay, David, thank you very much for coming on the show today, and thank you very much for your insight.
It's been a pleasure to be with you.
This has been your Forex News with David Powell from IDEAglobal. Next up, we have your equities and commodities wrap-up for the day. U.S. stocks ended a choppy session on a mixed note after moving in and out of positive territory. Wall Street weighed news that the government would allow Fannie Mae and Freddie Mac to buy more loans. The government removed restrictions on the size of their portfolios. Also, Fed Chairman Bernanke said the central bank will remain vigilant about the U.S. economy. In today's data releases, the Commerce Department reported that durable goods orders fell 5.3% in January. Ex-transportation, the figure was down 1.6%. Meanwhile, the Commerce Department reported that new home sales fell in January for a third straight month. The figure for new home sales fell by 2.8% last month to a seasonally adjusted annual rate of 588,000 units. That's the slowest pace since February of 1995. And the median price of a new home fell to $216,000 in January. At the closing bell, the Dow Jones Industrial Average added 9.36 points to end at 12,694.28. The tech-heavy Nasdaq added 8.79 to close at 2,353.78. And the S&P 500 fell 1.27 points to close at 1,380.02. In the fixed income market, U.S. Treasury bonds rose as U.S. equities started to decline in late afternoon trade. The benchmark 10-year Treasury note rose with its yield down at 3.85% from 3.86% late in the previous session. Meanwhile, the 2-year note was up with its yield down at 1.98% from 2.01% in the previous session. Taking a look at energy, NYMEX crude oil futures hit a record intraday high, rising above $102 a barrel for the first time. Prices pulled back after this morning's U.S. inventory data. The EIA reported that crude oil supplies rose by 3.2 million barrels in the latest week. April crude ended today's session down $1.24 at $99.64 a barrel on the NYMEX. Earlier, the contract hit a high of $102.08 a barrel. Taking a look at petroleum products, heating oil futures fell 4.39 cents to end at $2.7711. Meanwhile, gasoline futures fell by 7.28 cents, ending at $2.4777. Meanwhile, natural gas futures declined by 17 cents, ending the session at $9.035 per million BTU. Over in the metals complex, COMEX gold futures gained on the day, hitting another record high at $967.70 an ounce. This came as the U.S. dollar weakened against the majors and fell to an all-time low against the euro. April gold gained 1.3% on the day, adding $12.10 and settling up at $961 an ounce. In other metals, March silver added 49 cents, ending the session at $19.21 an ounce. March copper rose 6 cents to close the session at $3.84 a pound. Today we're joined by John Kilduff from IDEAglobal. He'll weigh in on energy futures in today's session and the pullback in prices.
Well, we have, Remy, we have crude oil prices down below the $100 a barrel mark for the first time in several sessions. Today, the sentiment about the weakening economy as it translates into softening energy demand, crude demand, gasoline demand, has clearly won out over the concerns about the continuing decline in the value of the dollar versus the euro in particular. We had a pretty solidly bearish inventory report where we saw another big build in crude oil inventories and gasoline inventories. And while the distillates did decline significantly, we are at the end or near the end of the winter fuel season. So the support that normally would have produced is clearly out of the market for now. Also, we seem to have gotten some good news out of BP for a change, in that looks like they're in the process of fully returning to operation their Texas City refinery that's been really at a half-running capacity situation since Hurricane Katrina. That could be a big boost for the refined product market in terms of inventories and supplies, which has continued to weigh on prices. And certainly, and as far as the bears go, the durable goods number today was of such a magnitude of decline that you could only see that would be weighing on prices, as it certainly feeds further into the fears of the recession. So while other commodities were higher today, gold most notably, crude and energy is not a inflation pure play. Crude oil in particular has to serve two masters, one being the currency pressures, the inflation pressures, but also has to abide the economic conditions and the outlook for the economy, hence the sell-off we we saw today. The $100 remains the pivot point, and will now be some overhead resistance. And we're also finally seeing natural gas give it up. It touched on its 10-day moving average. We think if tomorrow's inventory report there comes in soft, we could see further declines there. So this could be the beginning of a sell-off across the board for energy.
That was John Kilder from MF Global with his energy commentary. And that wraps it up for today's edition of PM Exchange. I'm Remy Hokie. Join us tomorrow morning for your latest news update right here on ForexTV.com. Have a good night.